We got those big earnings releases from the mega caps, Facebook, Google, Amazon. And we find out, of course, that their AI CapEx is just way above expectations on top of already huge AI CapEx budgets. And so what has driven so much growth, those mega cap companies in 2025, now has reason to be questioned. And then, of course, after Amazon's dump on Thursday, we see the Dow hit an all-time high over 50,000 on Friday. And so the market is trying to find some, I think, firm footing. And with all the headlines, it's having a hard time doing it right now.
It certainly is, and some of it's even hard to make sense of, or find any sort of consensus opinion on. But you mentioned the AI spend, certainly was in focus, has been in focus the past 2 weeks with the big names that we got and these massive CapEx numbers. Do you think that a lot of the volatility that we're seeing, or most of it, could be tied to all of the uncertainty around this AI spend and liquidity? Or is there something deeper sort of lurking in the macro backdrop?
The way I look at this specifically, I do think it is the market having to process what really is the largest industrial build-out in human history. We are going through a transformative time, and you can hear the commentary from Jensen and Zuckerberg and the other CEOs, Sundar, talking about just what level of transformation is happening right now. And the markets, because the price tags are just so big, are having to digest that. And we do know that in 2025, we saw how much that concentration really did affect the markets. And so when the street has reason to question that spend and ask, hey, hold on, we are spending incredible numbers here. Are we really going to get the ROI, out of that? That's, I think, really what's caused the VIX to spike up in the way that it has this last week. Obviously, I know we've seen a whole bunch of green this morning. I think that it is digesting that, and hopefully we can turn the corner and talk about the fundamentals, the ROI that is on the horizon.
Nvidia stock extended its recent gain early on Monday as investors assessed the potential for artificial intelligence infrastructure spending in the wake of big technology companies' high capital expenditure guidance. In early trade, Nvidia shares were up roughly 4% to $192.40. The move comes after a 7.9% rise on Friday, which ended a 5-day losing trend. The comeback has been fueled mostly by renewed optimism about further investment in data centers and advanced computing systems utilized for AI workloads. Nvidia's recent gains have been aided by large capital expenditure predictions from Alphabet and Amazon. Together with other major U.S. technology corporations, the two companies are likely to boost total industry capital spending past $650 billion this year, with a sizable amount going toward artificial intelligence infrastructure. However, despite Friday's rally and Monday's early gains, Nvidia shares are still marginally lower for the year. The company has encountered a number of headwinds, including a shift away from technology stocks, concerns about OpenAI's long-term spending, the increased usage of custom-designed AI processors by large customers, and rising memory component costs. Analysts at D.A. Davidson believe OpenAI's anticipated $100 billion investment round will boost sentiment toward companies closely associated with the AI development. We believe that once investors return to perceiving OpenAI as a winner, the public firms in its orbit will re-rate dramatically. Most crucially, this should fuel Nvidia's outperformance, according to D.A. Davidson analyst Gil Luria in a research note issued on Monday. Market investors have been closely monitoring OpenAI's funding plans, concerned that high capital requirements could reduce long-term returns for companies who supply its computing infrastructure. A successful fundraising campaign could alleviate some of these concerns. Nvidia CEO Jensen Huang has also attempted to reassure investors about the sustainability of the present spending cycle. On CNBC's halftime report on Friday, Huang stated that the technology industry's spike in capital expenditures on AI infrastructure is both justified and sustainable. The reason for this is that all of these companies' cash flows will begin to rise, Huang explained. He described the present wave of investment as the most extensive infrastructure build-out in human history, driven by sky-high demand for processing power. Huang stated that hyperscalers and AI-focused businesses are installing advanced systems to boost productivity and generate new revenue streams. NVIDIA CEO Jensen Huang has also attempted to reassure investors about the sustainability of the present spending cycle. On CNBC's halftime report on Friday, Huang stated that the technology industry's spike in capital expenditures on AI infrastructure is both justified and sustainable. The reason for this is that all of these companies' cash flows will begin to rise, Huang explained. He described the present wave of investment as the most extensive infrastructure build-out in human history, driven by sky-high demand for processing power. Huang stated that hyperscalers and AI-focused businesses are installing advanced systems to boost productivity and generate new revenue streams. Nvidia is rated a strong buy with a $209 price target, which represents a 25% upside and counters bearish forecasts of an impending AI bubble collapse. The company's competitive advantage is based on vertical integration of hardware, networking, and a leading CUDA software ecosystem with over 4.5 million active developers. Nvidia's fabless approach enables outstanding profitability, earning an industry-leading $2.76 million in net income for each employee on the payroll. Strategic investments and the extension of AI applications into robotics and medicine, rather than the current focus on massive language models, will drive future growth. Since the release of ChatGPT on November 30, 2022, Nvidia's revenues, profits, and stock price have increased at an incredible rate. AI tailwinds have driven Nvidia to the position of world's most valuable corporation, with a market valuation of $4.62 trillion at the time of this video. Furthermore, Nvidia is unquestionably at the epicenter of the new AI economy. At the same time, concerns about an AI bubble similar to the 1990s dot-com bubble have grown. On the surface, it's an appealing historical analogy. We're in the early stages of a technology that will revolutionize our daily lives in the same way that the internet did. The Shiller P/E ratio has soared to 40.5, the highest level in decades, and greater than it was during the peak of the dot-com boom. Google searches for AI bubble and dot-com bubble have recently increased rapidly, indicating a potential concern of history repeating again. Despite concerns about the AI bubble, I believe Nvidia is a good buy because of its incredibly strong moat in an industry with great long-term growth prospects. I feel that Nvidia is now cheap, with a price target of $209 per share and a strong buy rating. Nvidia is essentially the primary shovel designer for the AI revolution. The compute and AMP networking segment accounts for approximately 89% of Nvidia's overall revenue, with the conventional graphics business accounting for the remaining 11%. The H100 Hopper, Blackwell Ultra, GB200, 300, and the future Rubin platform are the most important products in the compute and network category. In terms of hardware, Nvidia operates similarly to Apple in data centers. The organization has implemented a one-year upgrade cycle, providing clients with a predictable product release schedule. Just like an Apple client can seamlessly upgrade from an iPhone 13 to 16, an Nvidia customer can easily upgrade their supercluster GPUs from the H100 to the new Rubin architecture. Companies can change Nvidia hardware without rewriting their programs. Join our investor community. Hit subscribe and like to get your daily Nvidia stock insights and tutorials delivered. Nvidia also creates the networking technologies Spectrum-X and InfiniBand for superclusters that employ its GPUs. If the chips represent the neurons of the data center, these networking platforms represent the synapses and neural pathways. They enable the hundreds of thousands or millions of processors in a huge data center to communicate with one another quickly and efficiently. These platforms are a crucial aspect of Nvidia's competitive moat since they ensure that customers get the most out of their superclusters. Broadcom, with its Tomahawk 6 switches, is Nvidia's strongest networking competitor. Data centers that do not use Nvidia CPUs typically use Broadcom gear as their networking backbone. AMD is, of course, Nvidia's main hardware competitor, but hyperscalers such as Alphabet and Amazon are also developing their own competitive hardware to cater to their own specific internal needs. A number of these companies have joined the Ultra Ethernet Consortium, which is essentially an anti-Nvidia alliance aimed at breaking the company's monopoly grip on high-performance computing networking. In my opinion, the most important component of Nvidia's moat is its software. Nvidia's CUDA program is entirely dominating, despite AMD's attempts to compete. Major AI frameworks or libraries, such as PyTorch and TensorFlow, run on the CUDA platform, with extremely high switching costs. Over 4.5 million developers use CUDA today, growing from 1.8 million in 2020. CUDA has already been used to write so much code that it is a common necessity for careers in AI programming and development, as well as a regular subject in colleges. That means the platform's strength is self-sustaining, as developers only need to understand how to use it. This is where I believe the competition falls behind, despite AMD's efforts to catch up with its ROCm7 software. Nvidia stands out since it is the only vertically integrated solution for data center computing. If you want to establish a data center without employing Nvidia GPUs, you must mix and match from other hardware, networking, and software sources. Nvidia remains the sole one-stop shop for comprehensive data center services. In my opinion, such proprietary mix provides the corporation with a significant moat. Nvidia's business model is fabless, which means it does not build its own hardware. It mostly relies on third-party foundries such as TSMC for production. This type of business strategy is a double-edged sword, as it allows the company to be incredibly capital efficient while simultaneously exposing supply chain and supplier weaknesses. Nvidia's lean business style is reflected in its profitability numbers. Here's how Nvidia compares to industry averages in different profitability and efficiency measures. Personally, I think the last indicator is the most amazing. Nvidia makes $2.76 million in net profits for each employee of the company. Nvidia generates profit per employee on par with, if not more than, the most profitable oil firms, despite not having the massive balance sheet of fixed assets required to accomplish so. Skeptics claim that such extraordinary profitability and efficiency are unsustainable in the long run, but I believe Nvidia's large moat will protect company from diminishing margins in the short to medium term. In my opinion, the greatest risk to Nvidia is not prospective supply chain interruptions or individual competitors, but if the entire AI sector is in a bubble. Nvidia is possibly the only stock in which one's broader worldview is likely to influence one's opinion of the stock. If you believe we are only taking the initial steps toward a new AI world, you are most certainly an Nvidia investor. If, on the other hand, you believe we are living in a moment similar to the dot-com bubble, with many of these AI initiatives and firms failing, you are likely to believe Nvidia is significantly overvalued. So the AI bubble concept must be addressed before determining if Nvidia is a buy or not. In this section, I will present what I perceive to be the 4 strongest arguments for that thesis, as well as explain why I feel they are inaccurate. 1. There is a mismatch between AI-related expenses and potential revenue. So far, evidence reveals that enterprises are unable to determine a return on investment for their AI spending. Deutsche Bank claims there is a $800 billion gap between predicted income and infrastructure costs. That means that Nvidia's clients will eventually run out of funds to continue purchasing chips for infrastructure development. OpenAI's planned transition to an ad-supported economic model is a tacit admission that the subscription model cannot cover expenditures. However, just because LLMs aren't fully monetized yet doesn't indicate they never will be. Some contend that LLMs have already reached their limits and are simply ineffective text predictors. Technically, that is correct. LLMs are trained to predict the likely next word. In practice, I believe they function similarly to a talking encyclopedia. On its own, that feature is extremely valuable, as proven by the astonishing fact that 34% of US adults use an LLM at least once a day, with an additional 18% using LLMs many times per week. So, more than half of the US population regularly interacts with LLMs. I believe we can find a way to efficiently commercialize something that half of the population utilizes on a daily or weekly basis. That may necessitate advertisements, higher subscription costs, or more tiered options, but I am convinced that for such a valuable product, we will figure out how to make it a sustainable, lucrative business. 2. Increased scaling leads to decreasing rewards. Most LLM users would have recognized the increases in intelligence when early models were released, but the variations between succeeding models are now much more subtle. In other words, firms are spending hundreds of billions of dollars on tiny increases in model performance. Although LLMs are anticipated to plateau, they remain incredibly valuable and widely used tools. Furthermore, AI encompasses much more than LLMs. The majority of progress follows a logistic curve, in which rapid advancement occurs early on and subsequently slows to the point where each incremental amount of progress is extremely difficult to obtain. It's similar to how large leaps were made in early iPhone models, but newer versions are difficult to distinguish. However, if you compare your current iPhone to an iPhone 8, You'll notice that advancement is still pretty evident when you zoom out. However, Nvidia does more than just offer chips to firms that train LLMs. LLMs are merely the top of the AI iceberg. AI applications are growing far beyond LLMs. We want AI to conduct a variety of beneficial tasks, such as drive your car, perform surgery, discover new medicines, cook your supper, predict extreme weather events, and much more. Simulating real physics or molecular biology demands significantly more processing resources than training linguistic models. All of these applications use NVIDIA hardware. To process real-world data, you need the best GPUs and the best software to go with them. NVIDIA presently leads on both fronts. Its hardware is best in class, and the next Rubin platform is expected to boost inference performance by 5x and training performance by 3.5x over the Blackwell platform. 3. Just because hyperscalers spend a fortune on data centers does not imply that it is an intelligent or sustainable use of capital. Another risk is that hyperscaler expenditure is unsustainable, and that hyperscalers are flocking together like lemmings towards a capex cliff. It's a seductive but incorrect reasoning to believe that just because huge corporations spend hundreds of billions of dollars, that spending must be beneficial. The concern for NVIDIA is that enormous capex spending without ROI cannot be sustained permanently. Continuing to spend without return on investment is like fighting gravity, thus hyperscalers may finally quit buying. NVIDIA's current $4.4 trillion valuation is based on eternal growth, not a sudden reduction in orders. Furthermore, some doubters feel that much of this spending is fictitious since money movements are circulatory. NVIDIA, for example, has stated that it intends to invest up to $100 billion in OpenAI over a 10-year period, thus providing the business money to buy NVIDIA products. This phenomena has been dubbed the AI Ouroboros by critics, after the snake that devours its own tail. This tendency is clear in the following chart, which I'm sure almost every NVIDIA investor has seen by now. However, the circular economy really benefits NVIDIA. I would argue that what we're seeing here is simply a representation of how an industry in an economy operates. Replace NVIDIA with the US government at the center, and the orbiting circles with defense contractors, and you have a visual representation of how the defense sector operates. Infrastructure buildouts, in particular, are circular. Consider when we built railroads. Railroads bought steel from steel companies to create infrastructure and trains, while steel firms used railroads to move raw materials and completed goods. This figure also highlights NVIDIA's many revenue streams. NVIDIA's customers include hyperscalers such as Meta, Alphabet, Microsoft, Amazon, and Oracle, as well as smaller infrastructure providers such as OpenAI, xAI, and Cloudflare. Of course, NVIDIA is likely to gain access to the big Chinese market for its H200 chips. Jensen Huang said that H200 sales in the Chinese market might provide an annual income stream of $50 billion for the company, with Alibaba, Tencent, and ByteDance allegedly willing to buy large quantities of chips. So NVIDIA has a lot of huge customers with deep pockets and almost no competition, at least for its high-end products. Furthermore, NVIDIA's investment in startups such as OpenAI, xAI, and CoreWeave is a sound approach because it integrates these emerging AI labs into NVIDIA's ecosystem. Once these labs' software architectures are developed on CUDA, the switching costs skyrocket. It also provides NVIDIA with a front-row seat to the bleeding edge of AI development, allowing them to design the next generations of chips in ways that will best satisfy future needs. So, in my opinion, NVIDIA is making sound strategic investments that will protect its future revenues. The goal is not to cook the books right now. Rather, it is to lay the groundwork for a future ecosystem into which trillions of dollars will flow. Some are concerned that OpenAI's $1.4 trillion in spending commitments over the next 8 years would make the company too big to fail, and that the contagion will spread to companies such as Nvidia. But the US government has an incentive to ensure that OpenAI and similar companies do not fail. Failures of key US AI startups will jeopardize the country's attempt to become the leader in artificial intelligence over China. When failure is too costly to consider, the US government will pay what is necessary to ensure success, just as it does with defense spending. 4. Once the buying stops, so does the scarcity premium. NVIDIA is currently able to maintain 75% gross margins because to high demand and low competition. If demand decreases and competition increases, margins may become unsustainable. If all of the above threats materialize, Nvidia may lose sales and margins at the same time, reducing profitability on both sides. However, due to Nvidia's strong moat, vertical integration, and supremacy in current infrastructure, meaningful competition is a long way off, in my opinion. As long as we continue to develop AI applications, even if LLM training declines, Nvidia's devices will be in strong demand for the foreseeable future. As long as human intelligence discovers methods to leverage computational power to develop intelligent systems that do useful things, Nvidia chips will be required to train and deploy those systems. Valuation. I utilize a discounted free cash flow model to value Nvidia stock. I expect that revenues will expand in accordance with average analyst projections until 2030. I also assume that free cash flow to sales is steady till 2030. From 2031 to 2035, I assume 10% annual growth in free cash flows, followed by a 4% growth rate in perpetuity. Furthermore, I use a FAMA French model to calculate a weighted average cost of capital of 9%. For those interested, I've included the WACC calculation in the spreadsheet at the conclusion of this section, which you may download and use to estimate the share price based on your own assumptions. I utilize the market beta of 1.6, the SMB beta of 0.5, and the HML beta of 0.7. SMB, small minus big, and HML, high minus low, are negative for Nvidia since they represent premiums for small cap and value stocks, whereas Nvidia is a mega cap growth stock. I feel that owning Nvidia is mostly dependent on one's belief in the future of AI. If you believe we are nearing the conclusion of an AI-driven bubble, Nvidia is probably not a stock you want to purchase. If, like me, you feel that we are at the start of an AI-driven societal transformation, Nvidia is a company that provides significant growth at a reasonable price. My $219 price objective is around a 25% increase over the stock's market value at the time of this video. Normally, outstanding firms price at a premium, but Nvidia is currently trading at a discount to its fair FCF value, hence I rank the company as a good buy. Don't forget to share your thoughts and experiences in the comments below. Your input helps create a more knowledgeable community where we can all learn and grow together in the world of investing. Stay up to date with the latest market trends, insights, and key updates by subscribing to Investing Tutorial. We're here to help you make smarter investment decisions and stay ahead of the curve.